and welcome to this short video tutorial on trading the Dow Jones Implied Volatility. In this brief video we're going to start off by looking at what implied volatility is. It sounds very complicated, but I can assure you that within the next few minutes you will find it's actually quite simple indeed. We'll then go on and look at the two most powerful trade setups that we can get with the implied volatility. And I will show you how to apply this to the Dow Jones and how to take advantage of the trades that the implied volatility actually sets up. And then of course it's no good if you can't actually find where to get the implied volatility from, so in the final section of this video I'll show you where to actually view the Dow Jones implied volatility free of charge, and then of course apply the principles that you're going to see in this video. So let's move on and have a look at what is implied volatility. Well, implied volatility is a measurement of risk. It's the insurance cost of an options premium. Put very simply, it's the same as any insurance, whether it's car, health, house, whatever. Whatever risk there may be, then the premium becomes loaded. In the markets, this is measured by market crashes, potential fall in stock prices, fall in gold prices, whatever it is. Whatever the risk is, then the option premium that a lot of people trade, the options in the markets, will actually become more expensive if the implied volatility increases. So the implied volatility is just simply a measurement of the risk in the market. So if the volatility is low, there is less risk, and of course if there's a lot of risk in the market, then the options will be expensive. And it's the measurement of this risk is what we're going to use in order to predict what the Dow is likely to do. So if there's more risk, the implied volatility will be high, and if there's less risk, i.e. that's the underlying market falling, then the implied volatility will be low. So let's have a look at this in a chart format, because that's the way to actually view this and to probably understand it. So this is an implied volatility chart. Don't be put off by the up and down lines, making it look complicated. It's not. If we look at the mustard colored line, that's the implied volatility, and it shows you this at the bottom, and this is the one that indicates whether the underlying options are cheap or expensive. So where you can see these spikes, the options in this market have become expensive, which means of course that the Dow Jones must have been falling at the time, because the risk in the stock market, for anybody who trades the stock market, they are generally buyers of the market. So any fall in the stock market is going to reduce the return on the portfolio that's held. So as the market drops, the options become more expensive because people run for cover. They buy options to actually hedge their positions, and the options traders know this, so they mark up the price for the options and sell expensive options to people who don't know how this actually works. So keeping it simple, when there is no risk, the implied volatility will be low, and if there's no risk, it means that the Dow Jones is moving higher. And as the Dow Jones corrects through selling or geopolitical events, whatever it may be, or domestic events, the Dow Jones will the options will increase in value. They make the options more expensive to buy to hedge the portfolios, and then you see the market stop and the implied volatility drops, so the options become cheap once more, which means that the Dow Jones has found support and then is moving higher. And let me just show you this on the Dow Jones chart. Let me just get a chart up for you. Let me just bring this in so you can see the opposite effect. So this is the Dow Jones, and if we just come back to more current times and then have a look at the correlation between the implied volatility and the Dow Jones. So let's just bring this back to the current time, which is anywhere around about now. So this is 2014. Let me just go back to the implied volatility, and you can see that in February the options were very cheap. The market was moving to the upside. You can see there you've got 2013, 2014, the market was moving up, started to struggle, and then we see a sudden drop off in stock prices. And when the risk to the downside started to move lower, we see that the options became more expensive. In fact, 100% more expensive get to the right place here. So from 9% area in January, we can see the options doubling in value, or the implied volatility doubling in value. We'll come to this in just a moment because this is very important. So anybody that was buying options would have paid through the nose at this point, but knowing the little trick I'm going to show you in a minute, if you had got this information when we had this correction in the market, then you would have actually reversed the position and been a buyer of the market. I'm going to come to that in just a moment. What I want to do here is to show you that when the Dow goes down, the options become more expensive, which you can see here, and then in August, September, and then last year in June and July as well. So if we look at the chart now, we can see that we're in the lows as far as the options are concerned. So at the moment, the market isn't seeing too much of a risk, and we can see that prices are back up to the highs on the left here. So let's just move on with the presentation, because I want to come to the two trading opportunities that the Dow implied will actually give us, and there are only two things that you actually need to know. Rule number one: when the implied volatility is at historic lows or multi-year lows, the underlying market will make a big move. That is that the implied volatility is trading at or below 10%. Let's go back to the current chart of the implied volatility. And what we actually see here is that the implied volatility is trading at the lows. Historic lows. In fact, this is the lowest it's been for a long time. It's nearly a year, well, certainly a year in this chart, and this chart only goes out to 1 year. So we can see we've got a year low in the implied volatility, and according to the rule that we just saw, when we have historic lows in implied volatility, the underlying market is likely to make a big move. Well, if the market's been trading higher, we can expect a move to the downside. So if we're trading the Dow Jones at the moment, at this time of recording, we have rule number one: historic lows in implied volatility indicates that the underlying market is likely to make a big move. The big move we're looking for, of course, is a move to the downside. So if we're a buyer of the market at the moment, we ought to be very careful, because the market is indicating to us that when we get these historic lows in implied volatility, we can expect a fall in the price of stocks. The options may be cheap, but when you get this setup where the implied is 10% or below historic lows, then you will get a correction in the market. Rule number one. That's all that's required, and all it takes to actually find that trade setup is purely and simply by looking at the implied volatility chart. And I'm just going to go back to that chart for you, and there you can see at the moment we are down into these lows. I will get you the value of these in a moment when I show you where to actually get the implied volatility charts from. At the moment, what's important is you understand rule one: historic lows in implied volatility indicates to you, alarm bells should be ringing, that we can expect a correction in this market. So the sell side is going to be the best side once this market breaks. The only thing in rule number one that we cannot pinpoint is the day or the catalyst that will create the move to the downside. That's just impossible without a crystal ball. But all is not lost, because once a market does break to the downside, it will scramble back up to try and hold on the actual highs. And when it does this, then we can take advantage by actually positioning ourselves to then get the remainder of the move to the downside. So that's rule number one. And again, just to recap, when you get historic lows in the Dow Jones or any other volatility, but in this particular case in the Dow Jones, when it's trading at historic lows, i.e. below 10%, the underlying market is likely to make a significant move to the downside. So that's the first way, or the first opportunity, and the first rule of trading with implied volatility is that we can gauge and predict that the market is going to make a correction. But the one caveat, as I said earlier, is we can't pinpoint the day. So this brings us on to rule 2. And rule 2 is after the move has been made. Now this one we can actually work with. We can actually predict this one when the market is likely to turn around. The first one we can't. We have to react to it. But in rule 2, when the market has made that correction and that move, and the implied volatility, the cost aspect of the options has doubled, then we can consider buying back into the market. So let's go back to the implied volatility chart once more. Rule 2, when the implied volatility doubles, the underlying market will stop and reverse, and you will see prices, the underlying prices, return back to the highs. So let's go back to February again. We've got at least 9% here, and then we see the market trading above 17, 16, 18, in that sort of area there. So the market was quiet in January. We had the correction in the market. We were foretold the correction was coming because of the lows in the implied there, and then we see the doubling of the implied. And effectively what you've got at this situation here is that if you were to use the analogy of a beer glass and pouring beer into the glass, then you would have a glass full of froth. And when the market's falling or falls sharply, then what the amateur trader does is goes and buys these expensive options, and what they're really buying is just the froth. There is no intrinsic value whatsoever contained within those options. And of course what happens is the market then finds support, which we'll go to the chart now and look. So we see the market finding support, it reverses and then starts to come back up, and those very expensive options that the amateur has paid for become worthless, and they lose the whole amount of money that they've paid for them, unless they get out of the position, of course. So when the pint glass is full of froth, the options are very expensive, which is indicated by that just that 100% increase in the implied volatility, that mustard coloured line just doubling in its value, which we see there. Then the underlying market 9 times out of 10 will stop, trade sideways, find support, and then move back to the upside. So in summary, 2 very simple trades. 1, we get the market where the implied volatility makes historic lows, so we can expect the correction in the market. And rule 2, once the market has made the correction, we just look for the doubling of the implied volatility, the pint glass full of froth, in order to buy back into the market and then trade back with the market. This is a shakeout. This is normal behavior by professional traders to shake out the general public, and then they will buy back in and move the market back to the upside. So let's just move on, and let me show you where to actually get the implied volatility from. You may want to pause the video here just before we do and make a note of these, so that you can get this into your subconscious mind, so that it's automatic. You know these 2 rules. They're very simple. It couldn't be any easier. So where do you get the implied volatility from? Well, believe it or not, the website is ivolatility.com. So let me just go to this website for you, ivolatility.com. When you first come to this site, you will have to register, and you do that. I'm automatically logged in, but you'll see a register for the site here. And once you've registered, you can just log in as you would any other site, And the symbol you want for the Dow Jones is, believe it or not, DJX. And then you just highlight it, click on go, and this will bring up the Dow volatility table and the charts on the right hand side. So you've got the price chart there of the underlying market. That's the Dow Jones. You can see where it's trading, and if I just go back, you also get the implied volatility chart, and this is the one you want to come and have a look at on a daily basis. So here we go, and there you can see the volatility chart. And if you look to here, you can see that we have this table as well, and the line that we're interested in is this one here, the IV index mean. Again, don't read too much into the complexity of this, because the two rules which I've given you are very, very simple. And what you're looking for is the mean to be below 10 or below, for the clue that the Dow Jones is likely to go through a selling phase. And at the moment you can see I'm recording this on the Sunday night 25th of May, and on the 23rd, which is Friday, you can see that we are below the 10% area there. Now if I just zoom in on this chart using Windows, it's Control and the plus key, you can actually make the chart larger as well inside of the window, and then just using the scroll bars fit this inside of the browser window there. So you can see now that we are heading down. This is the lowest it's been. I've already mentioned this, but it's well worth reinforcing that we have rule number one, historic lows and implied volatility for the Dow, so we can expect, I don't know when, that's the only bit that we can't throw into this variable or into this rule, but as night follows day, this is going to happen. Now, just before I conclude, I would just like to tell you that this is the 20th year I've been looking at the implied volatility, and it goes back to when I uncovered this, 1994. It was in the coffee market. The coffee prices had moved sharply higher. Let me just see if I can find the coffee chart. We had this big spike in the coffee market, and this is when I started looking at the implied volatility. The price of coffee had risen, the options had, or the implied volatility had doubled in value as well. So I did a lot of research, put a spreadsheet together, started crunching some numbers, and discovered that when the pint glass was full of froth, i.e. 100% increase in the implied, you know, the chart going from 10 to 20%, just that mustard line, then I knew that the underlying market had made its move and finished. And that's exactly what happened here. A lot of people were getting into the coffee market. They started to believe the mainstream media that coffee prices were going to the moon, and then we see them come back to more or less where they started. And then the same thing again in 1997. In 1996, I wrote about this for the first time, and at that time I was trading with a brokerage firm in California called Opportunities and Options. And the then CEO of the company heard about the book, and the reason why he was interested is because he'd already written a book himself, which came out in 1993, called The Option Secret. And inside of this book, he spoke about these historic lows in the implied volatility, which is where I got that one from. But then the forecasting at the end of a market move is what I uncovered myself, this 100% increase in the implied volatility. So off to California I went, sat down with David Kaplan, and we talked about different strategies and techniques of using the implied volatility. I actually didn't give him the details of what I'd actually uncovered. I kept that one to myself, and I didn't release that, I don't think, until 1998 was the first time I actually wrote about that. And I was asked by CRB, Commodity Research Bureau, who asked me if I would write an article for their magazine at the time. This is the now online version. This is the archive version of this article. It was in newspaper format at the time. But of course everything's electronic, and fortunately they've archived it on their server, so you can actually see this as well. So what I will do is post the link in the email so you can actually come directly to this as well, save you having to actually find it. So this article was printed in 1998. I then returned back to California, was invited to the launch of the mini S&P as well, which has been trading now for 15 years. And then the following year, I was asked by Futures Magazine if I would do a presentation in Florida, Orlando, for a lot of the major players in the market at that time. Trader Vic, who master a fortune of 200 million. And I thought, what can I actually present there? And I thought what I would do is actually launch this out to the professionals, which is an irony, really, because I actually wrote a book called Don't Tell the Professionals, and then decided to actually show this just to gauge what their reaction would be. So during the presentation, I had a bottle of beer and a glass, and I went along with the analogy of how the froth in the beer glass represented the overvalued options and so on and so forth. And it was met with great enthusiasm, lots of chats after with a lot of the professional traders about it. And what led on from that was the book then ended up being published in the US through Tradewinds Publishing. It's still on their website. I think it's out of print now anyway. And you wouldn't need to buy it because I'm showing you it all here anyway. So, but that's how the story evolved. So what went from uncovering this 100% increase in the implied volatility led on this journey to it being shown around the globe at the time in the 1990s. So it's something that's not really been shown for some time now. I think 2006 it had its last outing, but it's an amazing indicator when traded in conjunction with the underlying market and those two very simple rules. Something else that I want to add into the mix here at the moment as well. In fact, I'm just going to go back to the Dow Jones, and I'm going to create a monthly chart. I'm just going to convert this to a monthly chart so that you can actually see how much this market has moved in the last few years. Here you can see we've got the credit crunch there where the market sold off. And in fact, I'm going to go back prior to this because I want to just give you the story behind the Dow Jones for the last 10 years. In 2001, we all know about September the 11th. We can see there the market retracing, and then weapons of mass destruction talks, and then eventually Bush and Blair decide to go to war with Iraq, and unfortunately wars are good for the stock market because it leads to infrastructure contracts. And we see the Dow then moving higher. And then the printing of debt started in 2006. George Bush went berserk and they started printing money. They had a housing boom, as we did in the UK. The banks then became more corrupt than they are. And, of course, the toxic mortgages. And then we see in 2007 we had this sort of minor correction here in August, and I'm going to come back to that in just a moment as well. So then the credit crunch came in, and it's funny that we end up back where we started in 2003 before the warmongering with Bush and Blair and the market being moved up on funny money. And then just to add insult to injury, from 2009 the market has had more funny money, and you can see now we've got this more sort of vertical rise in the Dow Jones, and we've had corrections along the way which were already predicted or factored in by the implied volatility before they actually happened as well. They were preempted by the implied volatility, and you can see now we're sitting in these lofty levels, and we've got the historic lows in the implied volatility. So it looks like we've got a decent move to the downside coming out of this. So let's just go back to 2007, because in 2007, I'll bring this back in August of 2007, I was looking through for some material for you, just so that you could see that this isn't something that I've just come up with, that there is a backstory to it of some 20 years, and that it has a track record of actually working as well, which is why, of course, I'm compiling it now so that you can see it work as we go into the next phase of the Dow Jones having a major correction, in my opinion. Of course, it is slightly different than in 2007 because we didn't have the QE situation then. It was toxic money. Now we have the QE, so Yellen could decide to continue to print for a while and we could see the implied volatility go lower. But all I will say in answer to that is the lower the volatility, the bigger the move will be in the Dow Jones when it comes as well. But just going back to 2007, I used to record a market view then. And in those days, we were able to get implied volatility charts from a company that offered them free of charge. And it became so popular with what I was doing at the time that they removed the facility, hence moving over to ivolatility.com now to actually obtain this. But again, you can see the market was down in the lows. We had the correction in the underlying market, which is here in August of 2007. This market view, and I'll just bring this down so you can verify it, was for the 23rd of the 8th, 2007. And if I just move the playhead along there, you can see I'm pointing to the implied there. And this was a trade that I took on that day, on the 22nd of August, of some 80 pips as the market moved higher. Let me see if I can just capture this for you. Just one second as well. And the reason I bought it, and that's why I sent the email out in the morning, and also that the market would move higher, it would go through 61, 63. And here you can see the trade in progress, and I've obviously condensed the whole of the trading day down into just a couple of minutes here. And yesterday, as the screen shows here, I bought early yesterday morning after completing the MO at 60.90 and rode it throughout the day. I didn't go in and out all day as an intraday trader. I just took the position, held the position, and took 80 points on this. And the reason I did this trade isn't because it was a good idea. I did it because of everything that is taught in the course, and mainly because the implied volatility dropped yesterday. I thought I will have a piece of the action. It just seemed that the market was going to move, and that's precisely what it did. So there you see, back in 2007, when the implied volatility, the market had already made its move, it had put in the correction, and then we used this information. I'll just bring that back just a bit. There we go. I was able to use this information of the doubling of the implied to actually buy back this market, and that's back in 2007. There are, like I say, there's the articles, there's the speaking events where I've spoken about this as well, and also I found another article for the grain markets that I wrote about in when was this one? Let's just have a look. It was a free report about the grain markets, pointing out that we had historic lows in these. This is in 05. You can see there it's 7th of July 2005 that we could expect to see the grain markets move higher. And if let's just look at the corn one, that's the July corn in 2005. And if you go and have a look at the corn market now in 2014, and if we just look at a monthly chart of it, you can see through 2005 to 2006, 2007 and 2008 that we had a massive move in the market, and again preempted by what we saw in the implied volatility charts, because once these markets move, they move an awful long way. It was the same with the soybeans. Like I say, this was just a report I did with regards to the grain markets back in 2005, and you can see again the implied volatility gave the clue that we were on to some major moves in these markets, and that's precisely what actually happened there as well. So that's about it for this video. I hope you can see the value in this, and obviously that the implied volatility does form a major part of understanding and actually finding, most importantly, the trading opportunities within the Dow Jones, so you know that you're trading with the trend if you're going to trade smaller time frames or longer time frames. Of course, you only drop me a note if you want to know my opinion on it at the time, but of course that will be in the market view anyway, because we will be reporting in and looking at this more or less on a daily basis anyway. But that's the tutorial behind it, that's the story behind it. So like with all things, if you need any help, then please do get in touch. And as ever, thank you for your support and also taking the time to watch this. I will see you in the next one.